welcome to the very second show of Living with S. You guys were so amazing yesterday with all the love that you showed us. Thank you. We appreciate you. I am your host, Sharon Mundia, but you can also call me S. And today we're talking about something that I get very passionate about, but I don't get to talk about often because it's one of those taboo things that you can only have with a few people in your life. But we're about to just step on that myth and just break into the world of money, and more specifically savings. Now, end month is, well, here. Tomorrow is the 1st of August, and we're determined to make sure that we manage our personal finances a lot better, because the days of, oh gosh, it's 23rd, now it's ndengu and tomato sauce. No, we're not doing that anymore. We are grown. We're now going to make wiser decisions with our money. But before we get even into the topic, remember to follow us on social media. That's Living with S on Facebook, Twitter, and Instagram. And you can leave us your comments if there are any questions that you have for us, maybe topics that you'd like us to touch on, or guests that you'd love to see on the show. Let us know on there. We also have an SMS line for those of you who aren't on social media. It should be on your screen right now, so feel free to SMS us. And we have a giveaway for you guys, just to say thank you for joining us. Now, my guest today is Rena Hicks. She is the money lady. She's the one that you want to talk to if you have any questions. She's got all the facts, all the statistics, everything. In fact, just before the show started, she was breaking it down to me that about 80% of Kenyans are bound to retire to poverty.
Yeah.
What?
Yes.
What?
Actually, that's a statement that was made by the CEO. So first of all, before I get into it, can I just say congratulations?
Oh,
I'm so happy for you.
Rena. In deep down, I'm doing like little dances, but I feel like if I really broke out into dance, I might just be fired. They'd be like, no, thank you. We don't need those dance moves on the show.
Yeah.
But I'm just so excited.
I'm excited as well.
I'm so happy that you get to join us.
Yeah,
and
thank you.
To give me all, to give us all the tips. Can you see really how excited about money? I'm like, give me the tips, Rena. But we're all getting tips because we're all being changed, right? And trying to make better decisions.
I think the reason we don't make good decisions is because we just don't know the reality of where things are.
Yeah.
And that statement I was saying was made by the chief executive of the RBA, the Retirement Benefit Authority.
Okay.
And he said that 80% of Kenyans who retire are going to retire poor, into poverty.
That's mind-boggling to me. 80% of Kenyans.
Yes.
And the thing is, it doesn't mean that you don't have a decent paying job, or you probably are driving a car. Your kids are probably going to a decent school, but you still don't put savings first. Is that?
Yeah, that's the issue. I think what's happening is that we live our lives every day spending money on wonderful things that we enjoy, not thinking about our future. And we don't think that we're growing old. We think somehow somebody somewhere is going to take care of my future. Yes, it'll fix itself and it's fine.
Yeah.
But the reality is it's not. The reality is a lot of people, even today, have such great opportunities to make great wealth and create passive income streams, so that then when they are in their 70s and 80s, when they can't work anymore, they have these passive income streams that are sorting them out. In fact, research globally shows that you need to work so that you are able to replace your current income with an income that is about 75% of your current income. So if you're not doing that, whether it is through a pension fund or some, a real estate opportunity that you invest in, so that then the income coming in works out to 75% of your current income, you're going to be in trouble.
You're going to be in trouble. And sure, I know that in Kenya the statistics are quite high when it comes to people who are living under the poverty line. So I know that for some people it's not possible to be putting money away every month. But there's also, I believe, a great number of people who are just too comfortable. But now I want to get into the world of savings, and maybe you could start by identifying the difference between savings and investment.
Saving and investing. So before I do that, you made a statement that I want to address.
Okay.
And it's the statement that we have Kenyans who are below the poverty line and so therefore cannot save.
Yeah.
While it is true, the reality is that irrespective of where you are at and what you do, you can find a way to carve out some money, even if it's 20 shillings a day.
Right.
right? It's something that you're
Yeah.
putting aside, and it can compound. And as long as you put it somewhere where you are saving, it's better than nothing.
Right.
And I remember a story that was covered by one of the media houses, and it was on a gentleman called Kibe Wamei. And Kibe Wamei is currently still in the same business where he polishes shoes and he roasts maize on the streets.
Okay.
And he made a decision, and he said he was going to save 200 shillings every single day. I think it was every single day.
Yeah.
And he did that for 14 years.
Wow.
And then after 14 years, bought himself a minibus matatu. This is like probably 3 years ago when this was featured.
Yeah.
And so he has a big minibus matatu. He has employed a driver and a conductor, and he still does
great hustle. So I guess
hustle. So
the lesson there is, even if you are living below poverty line, you can
Find
still
work.
find ways.
Find ways to find an income.
To
and
increase
save.
your income.
Yes.
And dedicate a good chunk of that to saving.
Absolutely.
Preach. That's why you're here today. Thank you.
Yeah.
Thank you.
So now,
savings and investments. What's the difference?
So there's a difference.
Okay.
So saving is really just putting money away towards meeting a certain goal.
Okay.
Maybe that goal could be, I want to put in a deposit for a home, I want to invest in XYZ, I want to travel to Mombasa, whatever that is. It's really just putting money away, and you don't want to take any risk on that money. You can also decide that that money is for an investment that is specific, right? So you don't want to risk the money. Investing is putting money away with a goal of making sure this money grows and covers you for 3 things, is what I usually say.
Okay.
For the risk of wherever it is you're going to put that money. So it has to cover you for risk, it has to cover you for inflation, and it has to cover you for the inconvenience of waiting and not enjoying now.
Okay. Risk, inflation, inconvenience.
Yes. So if you're investing your money, then it needs to give you a return that covers you for at least beyond inflation, beyond the risk that you're taking, for it to make sense. Now, if you're saving, you have to save first to be able to invest. Yeah, so the saving comes first. But if you just save, then you're also not going to do very much, because you need your money to work alongside you to grow, just as you're continuing to work and earn an income, so that then it compounds and results in a lot of growth, as opposed to just putting it in a bank.
So is it okay to have investments and not savings? If, say, you saved, you made the investments, and now you're like, oh, got it covered. Is it okay to then have investments and not savings?
No, it's not. Because if, say, an emergency takes place, and I have invested in a piece of land in Kitengela, I have houses in Mombasa, and I have shares in, I don't know which, KCB.
Right.
Yeah. Which I bought at 50 shillings, and now the price is 44.
Okay.
And I need this chunk of money.
Yeah.
What do I do? I have to sell my investments, and I'll probably sell and take a loss in one of the investments, so that then I can meet my emergency or my need. So it's advisable to always have a certain amount of money put aside to cater for any emergency that may come about. And usually, so it depends on the kind of work that you do, how easily it will be for you to replace your income should you lose your job. And so the number will differ for the different ones of us. But they give a range, analysts and experts give a range of about 3 months of your current living expenses to about 6 months. But if, for example, you have a rare career that, you know, nobody else, I mean, the people who can employ you are very few, then you need like 12 months.
Oh, so the industry you're in or your job also matters.
It matters.
Right.
So if you're in a job,
because you're trying to create a buffer
right,
between if something happened today and you being able to still live, pay rent, you know.
Yeah.
Okay. And now, say for instance, you do have a little bit of money set aside. Where are some of the places that you should be putting your money for savings?
For savings specifically? So for savings, we don't want to take any risk. So I'd put my money, if I could put it in a SACCO, so I could set up an account with a SACCO. SACCOs are great, by the way.
Okay.
A lot of millennials are just like, that was for my grandma.
Oh gosh, I live for SACCOs.
You do?
Yeah, then I guess I am the grandma. I live, and after when I got my second job, my first job actually, I remember after I left, after a year, I looked back and I thought, I have nothing to show for the money that I was making, which wasn't much, but I had nothing. And I told myself never again. So the second job, I got the second paycheck. I couldn't do it the first one because I had to wait before I got the forms and everything. But with the second month's pay,
Yeah.
it was already going. I was
Nice.
devoting some money to SACCOs. I fully believe in
because
them.
you get a dividend, by the way,
Yeah.
and they pay between about 8% to 15% per annum, and your money really is safe as long as you choose a good SACCO. There's also what we call money market funds, and a money market fund is an account that is set up, or a product, let me say, that's set up by insurance companies. And so insurance companies have different products. The one I would recommend personally that I like is the money market fund, because it's like a bank account.
Okay, I hope you're taking notes. I really wish, I really want to take this as a classroom, but it's okay, I'll take the notes after.
But
okay.
I will share the notes with you later. I mean, so what happens is these guys give better returns than you would get at your bank. Typically, because they invest the money in short-term near cash instruments. So like they'll negotiate rates with a bank and get certificates of deposit with a bank, and they'll get much better rates than you would, because they're giving 1 billion shillings and you're giving, 10,000 or 100,000. They invest in treasury bills, they invest in commercial paper, so different opportunities to be able to maximize the return they can get, so that then they give you a good return, which is better than you would get in your bank.
Okay.
Then you have savings accounts. You could decide it's too much trouble to go and open an account with a money market fund, although it's not too much trouble. And the beauty about it is that once you put your money away, you just need to give 2 to 3 days notice and you have your money back.
Okay, so that's decent for the emergencies that you're talking about.
Yeah,
At least it's
2 days to get money is not too bad.
Yeah.
But there's a savings account, as I said.
Yeah.
If you designate your account as a savings account, I think you should get at least 6.5% interest.
Okay.
There's fixed deposit accounts as well,
Yes.
where you can get even up to, I think, 8.5%. From
But it's locked in there for a certain amount of time.
Yes, it is. So now that becomes tricky
The
when it's an
tricky part,
emergency.
right.
So you would break it and then lose on, there's a penalty, so you lose on the interest.
Oh,
so you
I
would still
see.
get your money. If you break the deposit,
Yeah.
you just lose on the interest. So those are some of the things that
Some
you can
good
do
options.
for savings.
Yeah.
Yes.
We want to take a quick moment to show you a video that I loved on Rena Hicks' channel, which, by the way, you should be following, because she's there giving us all the little tips and the big tips on how to make your money work for you. So just take a look.
So if you have 50,000 shillings or less, one of the things that you can invest in is the stock market. Yes, shares. And a stock market is a place where people come to buy companies that are listed on the exchange or the stock market. And you can buy shares in the company, become a part owner in that company with the aim or the goal of making a capital gain. Or that means buying at a certain price, the price goes up in value, then you sell and you make that gain in the difference in price. Or you earn a dividend every year or every so often that the company issues a dividend once they make a profit. So you have two goals, either the capital gains or the dividends. Now the thing with the stock market is, by the way, even if you have just 3,000 shillings, you can invest in the stock market. The thing about the stock market is, in Kenya, the minimum number of shares you need to buy is only 100 shares, just 100. And that 100 will, obviously the value will be dependent on the shares you decide to buy. So the point is that you don't need a lot of money. Even with 1,000 shillings, you can invest in the stock market. So don't feel discouraged. The point is to start. And you can just accumulate depending on how often you get the money. The idea is to remain consistent. So you have less than 50,000 shillings out there, there's opportunities for you.
See what I mean when I say you should be following her? I loved that video. And I love that you didn't choose an amount like 5 million shillings, which can be, sometimes it feels like for you to invest, you need to have a $10,000 million. And so the fact that you picked 50 feels like an amount that we can all strive towards putting together.
Yeah.
So do you want to tell us a little bit more about that?
Actually, the decision to use the 50 is to make people understand that even with 10, because on the video I explain how much, for example, you need to be able to buy shares. If you want to put money in different investment opportunities, you don't have to have a lot of money.
Yeah.
And the truth is that a friend of mine also started in real estate, and he only had 50,000 shillings. And so what did he do? He got a couple of friends together, and they put their money together depending on their abilities, and they started, and he only had 50,000 shillings.
Yeah.
And so sometimes we prevent ourselves from thinking about opportunities that are out there because we don't have enough money. But the idea is to just think, what do I want to do and how can I participate in this opportunity that exists?
Yeah.
You can partner with somebody else, go to that company and ask, would you consider just taking what I have? So there could be an opportunity and they say, I'm sorry, the minimum is 5 million shillings.
Yeah.
But you know, you can negotiate or ask them, can you create a vehicle where a few of us can come in together and put the money, and then we have, you know, a vehicle that we use to then invest in this particular opportunity.
Yeah, and I like the idea of even having people, because then you have accountability partners who are checking in like, hey, where's your 50? We said Friday. Where is it now? So I love that idea.
Yeah.
Now going back to savings, how much of your salary should you be putting away towards savings?
So it depends on when you want to retire.
I want to retire now. Sorry, NTV. No kidding. I love my job. I never want to go anywhere on Instagram. But say, for instance, you wanted to retire at 40.
Wow.
Or 50. Let's say 50.
Okay.
40
so let's say, if you say 40, then from the
40
time
is
you
quite
start
young.
working like 20, you need to save at least 50% of your income consistently. Otherwise, you will,
Really?
yes. Yes.
Well, okay, I was just thinking, I guess in dream world, 40 would be great. But really, I think if you love your job, you might even want to just keep on going. So let's say 50 or 55.
Yeah.
Say that's the time that you should be
Retiring.
You're thinking of retiring, 55.
Yeah.
How much?
So realistically, I guess it also depends on how much you're earning, right? But it would be ideal if we assume that the current income you're earning is sustaining you and your current living expenses, you want to put aside at least 30%. At least 30%. I mean, at a minimum, let me say, at a minimum, let me put it this way. At a minimum, I say 12.5%.
Minimum 12.5%.
At a minimum, 12.5%. 12.5%, and the formula for that is really just looking at the day that you spend at work.
Okay.
And saying that if you just take 12.5% of the day and say that of your time, of your time, right? Then you will put that towards yourself, because you spend time paying 30% carry, 10% this, and you find you've worked the entire day and you've saved and made money rather for everybody, for that harambe or that person you're helping out of hospital or out of school or whatever it is, the landlord,
school fees.
Exactly.
It goes
all kinds of
everywhere.
expenses, and it all disappears. And what happens to you?
Yes.
What happens to you? So what you need to do is just say, I have to carve out for myself first, and make sure that at a minimum, bare minimum, 12.5%. Ideally though, 30. And the 30 is 10% goes towards my short-term goals.
Okay.
Because you see, you want to enjoy life, right?
Yeah.
And you want to be able to have fun and do things that you love, right? You want to travel, you want to do that sort of stuff. So then save that money and do that.
I love that. Ooh. Okay, I'm getting so excited because I love when we get tips. So 30%, 10% goes into short-term goals.
Yes,
which could also be like travel, spoil yourself a little.
Why not?
Okay.
And then 30%. 20%, sorry, that's the balance. 20% goes towards your long-term investments. So investments that you will not need to, dig into for at least 2-3 years and over.
Okay, so 20 investment, 10
short-term goals. Short-term goals, like, now in the next one year, 1.5.
And that's assuming you've already set up your emergency fund, right?
Yes. Well, so the emergency fund is a journey.
Okay.
I wouldn't advise somebody to say, I'm not investing, I'm going to set up my emergency fund, because then you miss out on opportunities to grow your money as well, right? So with the emergency fund, you work on it just the way that you work on your investing. So if say you earn, I don't know, your expenses are 200,000 a month, so times 3 comes to 600,000. And so I know I need an emergency fund of 600,000. If I have saved up, say, 2,000 now, then it'll take me a long time to get to 600,000, right?
Ooh,
So I can say that with my saving, my 10% out of the 30 will go towards my emergency fund.
Okay.
And so 10% of my income will go towards my emergency fund. Then 20 I will invest for the future. Okay. And then have it that way until you eventually get to your emergency fund. Even if it's a year and a half, 2 years.
2 years. It might take a while.
As long as you're working on it.
Yeah, and it's fine. Just baby steps. Because no one
baby
has
steps,
like
exactly.
600. Because you are, like you said, if you're earning 200 or your costs are 200 times, that's a
lot of money.
It's a lot of money. Now, I have a couple of scenarios here. And I want you to tell me whether it counts as an emergency or not. Because I know some of us are creating emergency funds and like, my hair needs a quick retouch. Let me go quick. You know, so we need to understand what's an emergency and what's not an emergency. Okay, so I want to go to Jamaica with my girls for a trip. Is that an emergency?
It depends. Are you from Jamaica? Did somebody die?
No. Rena said no in a sassy way, okay? Sorry, girl, you can't go on that trip. Okay, someone got ill. Maybe my child got ill, unexpected, and it's not covered by insurance.
No, that's emergency.
Emergency. My car battery suddenly dies on me, and it costs 60,000 shillings.
That's an emergency.
Emergency. My car insurance is due.
Yeah, it's
no?
We know every year at the same time, insurance falls due. It's like you're having a baby, right?
Yeah.
And you need to buy diapers as soon as you get out of hospital. Is that an emergency?
You knew 9 months.
You had 9 months head start.
You were planning. Okay. Which I guess makes this next one is I have to pay my electricity and my phone bill. Is that an emergency?
Unless Kenya Power pulls a nice one on you.
Oh, like I've seen those ones where your bill goes from like
3,000
to 65,000.
Yeah. So now, you know, the thing is with Kenya Power, you have to actually first pay and then now you sort out the problem and you get a credit note or something.
Right. Okay, so I guess,
it's
thank you for that. It's an emergency because, you know, Kenya Power. but a friend comes to you and they need an emergency loan.
Wow.
No pressure, Rena, but where do we go?
I have a very strong view on that.
Okay. Lay it on us.
So if my friend comes to me and she has an emergency and she needs a loan, I will not lend her money. I will give her what I can afford to give.
So you will not pick out of your emergency fund. You'll see what you've got.
So I have a given budget, and I should have a given budget.
Oh.
Yes.
Oh, wow. Okay.
So that every month there's something I'm giving towards.
Yeah.
So if, say, for example, maybe I've used up my giving fund already and she's a friend, then I'd find a way of looking at what can I go without.
Okay.
So that then my friend can have. But I will not lend. Because lending money to relatives and friends is a sure way to destroy relationships. Because they will... I don't know, I've just had a very horrible experience. But they just don't pay. They just
I know, I hear you. It can be tricky. The last one, real quick. You want to, it's time to pay off your loan. It's that time of the month. You need to pay off your loan. Is that an emergency?
No.
It's a monthly.
It's a loan. It's monthly. It comes. It's an emergency.
Okay.
You should have already made provision for that.
I hear you. Okay, thank you. The giveaway winners from yesterday's giveaway. 6 of you guys will be winning, and we will be sharing that with you at the end of the show. And also, now, quick fact. Did you know that the first ATM was built in 1967? That feels like a century ago, but it's not that long ago, but it is, isn't it?
Yes, it's a long time ago.
1960. How do you feel about ATMs, actually, Rena?
I hardly go to ATMs anymore.
Really? Is that
hardly?
Does that help you manage your money better, or is that just?
So I hear you should actually go to the ATM and use cash as you spend money, because you spend less when you actually see the cash leave your hands or your wallet. But when you get used to swiping, then you don't, that feeling of I'm losing, my money is going,
there's no
is not there.
association.
Yeah, so it's actually advisible to use the ATM and get cash and put it in your wallet and spend money.
Okay, well, thank you to whoever brought up the ATM, created the ATM 1967, all those years ago. But now I want to understand savings from the perspective of how much should you have in your account. And are there different accounts that meet different needs? So I know at the beginning you were saying that you could be saving for a trip and that there's an investment and then maybe the emergency fund. Should they all be in their own little pockets and spaces? Or can they be?
Again, it's individual based, I think.
Okay.
Depending on your personality. And if you find that if the money is all in one pot, it's difficult to track or even to remain disciplined about what you use. It's best to have, obviously it's best to have an account that is operational. So, the one where you're paying your school fees, your rent and all those sorts of things. Then you have a different account for your saving. And so the saving, then you can decide whether that's sufficient, or do you want to have an account that is specific for different aspects of that saving. So maybe you want to save for your trip, and you could open a different account to do that. I think there's nothing wrong with that, and it's okay to do that. There are people who decide we'll just have one account and then we'll use envelopes, and so you withdraw all the amount of money you need for the month, put it in envelopes, and put it in your house.
I've heard that envelope trick. Are there other tricks like those that we could take on? I was wondering actually if there is something that could help us save, maybe a challenge that we could go on for the month of August. And something that's simple and manageable, maybe a certain amount every day, or a tip or a trick on how to save.
So I was thinking about that actually, and I was wondering to myself, you know, we all know we should save. We all understand the importance of saving, and it's a good thing to do. But we just don't, right? And I think the reason we don't actually do that is because we don't have the motivation to. And some of the things that are before us are so compelling, and the desire to have them is so high, and so much higher than, you know, my future bank account size, you know? So I think a good place to start as a challenge is to agree, can we, for the next 30 days, sit down and reflect, like, authentically around what do I really want? What are my goals? What's my really deep desire? And whether that desire is in the next 2 weeks, in the next 6 months, in the next 1 year, in the next 30 years. What do you want for yourself? And just take time for like a whole week, 30 minutes every day, just dreaming about what you want to achieve and the life that you want to live. And I find that when you have a picture of what you want, it's like having a vision board, you know? And when you can see, this is the car I want to drive, the house I want to live in, the school I want to go to. I want my master's. I've always wanted to go back to school, and this is how much it's going to cost me to go back, and I don't know where to get the money from. But when you have it there, then you will look at that 10,000 pair of shoes and be like, it's okay. I'm saving for something. So I think goals are very powerful in helping us to do what we know we should do. So I think for the 30-day challenge, even if I say, let's save this amount of money, it might be difficult for people to actually, but if we agree for the next 30 days, let's put our goals down. And then after you've put your goals down, week 2 is put a price on each of those goals. Like, how much is it going to cost me to go on that trip? How much is it going to cost me to enroll for that course? How much is it going to cost me to do ABCD? And then list all the amounts against the goals. Because that's going to help you understand, my goodness, I have a long way to go, or actually I'm not doing too badly, and I can just continue to enjoy. Pat in the back. And then once you've done that, is sit down and look at, where am I at, like really? Because sometimes we actually have no clue how much do we owe, you know? I mean, we have, some of us borrow from your friend at work, from the neighbor, from the kiosk guy you've not paid back.
Later.
So how much do you actually owe? How much? So what I'm talking about is your net worth. We need to look at what are your assets right now? How much do you have cash in the bank? Do you even have an insurance policy that you signed up for out of duress, or some trying to get rid of this agent and you forgot about? Do you have that? How much is it? Do you have any other investment products that you forgot about? Maybe shares you bought some time ago that you can't even remember. Don't even know what the price is now. So take time to assess what is your net worth. That means looking at your assets, less your liabilities or what you owe, and let's see the figure now. Where are we starting from to be able to afford these goals?
What I really love about what you said is that you're starting with the why. Why are you saving? What does it mean to you? What is your vision? What is your dream? And then work backwards, and then now, you know, look at the reality. But we went to the streets and we asked you guys what you thought about savings. So take a look to see what your thoughts are.
I think savings is a good thing, as you know, it helps you, maybe let's say in let's say situations that maybe you don't have finance, and you really need that finance, and if you did some saving, it would really help.
I think saving is something that is very important, in that the upcoming generation, let me say, most of the people think life is all about YOLO, you get. But in real sense, you get that there's this aspect of growth in different levels, in that you need money in each aspect. You need money academic-wise, you need money in your future building. That is why I think saving is important, especially in Kenya. You do not know what happens next, because today you'll sleep knowing that a matchstick goes for 2 shillings, tomorrow it goes at 5 shillings. So it is only a shock to people who have not saved, but for people who have saved, I think nothing triggers them in a bad way, having that they have the savings.
Kenyans, mostly the youth, are not very good savers right now. You should be educated more on savings and be encouraged to save, because the future, you never know about the future.
In this current economy, it's a bit difficult because expenses are also on the high end, and it may take time before you can actually save anything meaningful to do something meaningful.
Savings really take a while, as per now the economy in Kenya, once you save a dime, with the economy and the inflation, you have to like take it back, so it gets hard to save. And with this, once you're employed with the salo, you know, the little that you're getting, it's very hard to maintain that consistency of saving.
Saving is a very good idea. I'm a good saver myself. I like, they say it says that kula tano weka tano. So me, I'm a good saver. I save with the circles and I take loans. I do my small development. It's a very good idea to save for the sake of the future. There's no need to enjoy your life now, then you suffer tomorrow. So I'm good on that.
Okay, some of you guys are quite opinionated on that, but thank you for sharing your views. Now, Rina, I want to get into couples, because a lot of times that's one topic that you leave to the back end. We'll talk about money later, and then next thing you know, you realize you're not financially compatible with your partner. So maybe they are a spender and you are a saver. So how do you bridge that gap and still have a strong, financially stable unit?
Yeah, it's a big sigh.
Yeah, it's a big. I was going to comment, and I thought, no, just let her speak.
But I think when two individuals come together from completely different families of origin that have completely different views of life generally, and particularly how to handle money and what's important, what's valuable, and what's not, it's very challenging to then align even goals and to align decisions on how you're going to spend money. Actually, the reason I give that big sigh, money has been my greatest pain point in marriage, and yet we have actually a really good marriage. And so it actually caused me to start doing a thing called Love and Money, and I started doing videos on love and money, because I'm just like, how are you guys surviving, and how are you doing this thing? Because it's very tricky. But to answer your question,
right,
you have to have conversations, endless conversations, to understand each other. One thing I found helps is understanding your money personality and your spouse's money personality, or your boyfriend's or girlfriend's money personality, because that helps you empathize with who they are and understand that they're not doing this to hurt you, to spite you, frustrate you, that it's actually out of maybe even love,
right,
you know, or just out of just who they are, that they're behaving the way that they are. So you have people who are hoarders, you have some who are spenders, you have some who are money monks and want to give away everything they own, and then there are others who are amassers and are workaholics, and you know, and don't want to spend time on things they find, you know, frivolous. So when you understand your partner and you're having conversations to deal with things that you both want, and you're dreaming together, because that's the other issue. Besides our differences, you have one spouse who's dreaming about living in this area, and the other one's just happy where we are. And so if you don't even align that, then
You're already lost.
Yeah, completely.
Yeah.
How are you going to live together
Yeah.
in the future? So it's about constantly having conversations where you share with one another, just be real.
Yeah.
Be real with one another, and walk with each other with the aim of just building this oneness, so that then you make decisions and you find a middle ground to be able to then live successfully and grow your finances successfully.
Yeah, and I know you said that it was a pain point in your relationship, but I think it's in many relationships. Conversations about money, arguments about money, doesn't matter if you've been dating 2 months or married 40 years. There's probably going to be, that moment you're like, why didn't you tell me? I went to their bank account and there was this money was gone, and it can be frustrating.
It can.
But now onto budget.
Right.
That word that we like to run away from because it's not a cool word.
It's not.
No one wants to budget. It's just so heavy and bleh. Even coming out of my mouth, it just feels heavy.
But not no one. There's some who love budgeting.
That's true. But those are very few. Those are very few people who live within their means and stick to the budget.
Yeah.
I think for most people, they're just like, budget, like it's fine. We will figure it out later.
Yeah.
What are some of your tips when it comes to that budget?
So first, change that word to spending plan.
You see, already I like that a little bit better than budget. I'm feeling comfortable about using that word.
Yeah, spending plan. This is how, and then also look at it as a tool. You're looking at it as a tool, and it is your slave. It is your tool to help you achieve your dreams. Because I think what happens is, in the way that we create budgets, we do it in such a way that makes it constricting for us. A lot of us just hear that word and we feel claustrophobic.
I think that's it. It
know?
just makes you feel like you're boxed in, like you have no room to live or do your hair or go for dinner.
So how I say that we need to do budgets is, I remember when we first got married, what we agreed with my husband is, let's just spend money, right? And track. So you write down every single thing you're spending money on.
Yeah.
That way then, as you create your budget, you're not creating a budget from the sky. How much do we spend on food?
Yeah.
And then write a number. How much do we spend on? No, you're not guessing.
Yeah.
It's actually based on a reality or the reality of your situation.
Yeah.
Then that way you can say, okay, maybe I'm spending too much on cereals. Let me have doma and arrowroots and sweet potatoes instead for breakfast, instead of Kellogg's cornflakes or Special K, whatever.
Too expensive.
Yeah. So once you've done your spending plan, then you actually look at what can I cut out, and what do I really love to do that I don't want to cut out, because then it's not going to be fun to do this thing. So then you keep what you really truly enjoy and things that you love. I love to go to the gym, or I love to, I don't know, read books. So just keep your book budget there and it's fine.
And then take out something else.
The others that you don't really care about, like what you eat for breakfast, then scrap the 1,000 shilling stuff and eat 20 bob stuff instead.
Yeah, but I like that. So you first start by spending and then track it, and then be honest with the things that you can cut out and the things that you can't. Man, I could talk to you for hours. I'm not kidding. I could literally sit here and be like, and next tip, and next tip. But we have come to an end of today's show. Thank you though so much, Rena Hicks. You've given us some really good pointers and a great word. What did you say?
Spending plan.
Spending plan, not budget anymore. So now it's time to announce the winners. Now the 6 winners from yesterday's giveaway are going to be on the screen. Congratulations. I feel like there should be fireworks and confetti in the studio right now. Thank you guys for sharing your thoughts and following us along. And remember, if you want to be a winner, you can also follow us on social media. That's Living with S on Facebook, Instagram, and Twitter. In fact, I think I'll ask you a bonus question there. So if you guys want to see her answer, make sure you're following Living with S. But you can also always SMS us with your thoughts. Now, tomorrow, 8 a.m., we are talking about love and about first dates. Our guest is a man who has been married for 7 years and has a great number of tips for you guys on how to make sure the first date you come out feeling strong and good about yourself. So make sure you join us tomorrow. Living with S. I am your host, Sharon Mundia, and thank you so much for watching.